In a span of just 4 days in April 2025, $5 trillion vanished from global equity markets. During the first Trump administration, a late-night social media post might swing a single defense contractor's stock for a few hours. In the second term, the mechanics evolved. The administration began generating sweeping macroeconomic arbitrage opportunities for highly capitalized institutional players. This wealth generation operates along two distinct axes: the indirect accumulation of billions by anonymous derivatives traders, and the direct accumulation of billions by the executive family through decentralized cryptocurrency. This blueprint illustrates Pillar 1, engineered volatility. Abrupt trade reversals create lucrative event-driven trading. Pillar 2 is tokenomic extraction, linking domestic policy to digital ventures to absorb foreign wealth. Beneath both is Pillar 3, structural capture, the dismantling of federal agencies that police financial markets. The administration has synchronized executive power and digital assets into a legally insulated architecture that monetizes the office of the presidency. On April 2, 2025, the president announced sweeping 10% baseline tariffs on all imported goods. The S&P 500 plunged toward a bear market. Exactly 1 week later, the market experienced a heavily foreshadowed reversal. This forensic timeline tracks executive communications, asset pricing, and derivatives volume on the morning of April 9th. At 9:33 a.m. Eastern, the president posted online telling the public to be cool. 4 minutes later, a highly specific financial directive followed. This is a great time to buy. At the exact moment of this post, the official U.S. trade representative was testifying before Congress, actively assuring lawmakers that the harsh tariffs would indeed take effect the following Wednesday. While the public policy track indicated severe trade restrictions, the derivatives market reacted to the executive signal. At 1 p.m., an unidentified entity purchased 5,105 call options, betting on a massive rebound for the S&P 500. They paid a premium of $4.20 per contract. At 1:18 p.m., the president bypassed traditional administrative channels and announced a sudden 90-day pause on nearly all reciprocal tariffs. The S&P 500 soared by 9.5%. Those call options skyrocketed to $42. A $2.14 million bet transformed into $21.44 million in under an hour. This pattern extends past domestic equities and into commodities markets tied to global conflicts. This data display reflects the extreme volatility in crude oil futures during periods of geopolitical tension. On March 26, 2026, the administration navigated heightened military tensions with Iran. Exactly 15 minutes before the president announced a 5-day pause on planned military strikes, traders executed a sudden $580 million short position on oil. These massive trades occurred during quiet pre-market sessions, devoid of traditional economic data releases. Timing a commodities drop to the exact minute of a de-escalation announcement strongly indicates the use of classified military intelligence. This information asymmetry exists within the administration itself. Financial disclosures from over 1,600 appointees show that senior officials across the executive branch consistently offloaded equities and purchased safe haven bonds in the hours immediately preceding market-cratering tariff announcements. By weaponizing abrupt trade reversals and leveraging classified military timelines, the executive apparatus engineers guaranteed arbitrage opportunities for anyone with advanced knowledge of the schedule. While anonymous shadow traders extract billions from the derivatives markets, the executive family has directly accumulated an estimated $1.5 billion through decentralized finance. This network map outlines World Liberty Financial, or WLFI, a decentralized protocol launched by the Trump family in late 2024. The platform's financial structure is highly specific. 75% of the net proceeds from all token sales channeled directly into a shell company controlled by the Trump family called DT Marks DeFi LLC. This digital asset venture relies heavily on massive capital injections from foreign sovereign wealth funds, creating an immediate intersection with national security. 4 days before the January 2025 inauguration, an investment vehicle backed by the National Security Advisor of the United Arab Emirates secretly acquired a 49% equity stake in World Liberty Financial. This $500 million Emirati investment generated an upfront cash payout of $187 million directly into the executive's private LLCs. During the prior administration, the U.S. intelligence community had severely restricted the UAE from acquiring advanced technology, citing the Emirates' deep intelligence ties to the Chinese Communist Party. Following the UAE's $500 million injection into the president's private protocol, the incoming administration abruptly reversed that national security posture. The White House approved export licenses guaranteeing the UAE 500,000 of the most advanced American AI semiconductor chips annually. The entanglement deepened when UAE sovereign funds utilized WLFI's stablecoin to facilitate a $2 billion investment into the cryptocurrency exchange Binance. Shortly after, the president issued a pardon to Binance's founder, who had previously been convicted of severe money laundering compliance failures. The digital protocol functions as an obfuscated financial conduit for foreign powers to secure specific U.S. policy shifts through direct capital injections into executive-controlled entities. Operating a private conduit for foreign wealth and signaling billion-dollar derivatives trades raises an immediate legal question. Why do these anomalies trigger zero federal enforcement actions? The answer lies in the systematic dismantling of the Department of Justice. Todd Blanche was installed as the second highest-ranking official to oversee federal law enforcement. Blanche issued a sweeping directive ending what he called regulation by prosecution. Crucially, he dissolved the National Cryptocurrency Enforcement Team, the specific DOJ unit dedicated to investigating crypto fraud and market manipulation. Financial disclosures revealed that Blanche maintained hundreds of thousands of dollars in personal cryptocurrency holdings while issuing directives that effectively shielded World Liberty Financial and its foreign partners from federal criminal probes. Simultaneously, the administration overhauled the Securities and Exchange Commission, installing Paul Atkins as chairman. This organizational flowchart shows a critical bureaucratic shift enacted in March 2025. The SEC revoked the delegated authority of its own enforcement division to autonomously issue formal orders of investigation. The new rule severs the division's subpoena power. To investigate a corporate crime, career staff must now route all subpoena requests through a bottleneck requiring direct approval from the politically appointed commission. Consequently, new SEC enforcement actions fell to their lowest levels in a decade, dropping 20% year over year. When congressional committees demanded investigations into the $950 million oil futures bets and the highly suspicious April tariff trades, the SEC met those requests with total inaction. By stripping federal investigators of their independent subpoena power, the administration guarantees that both the shadow traders executing the arbitrage and the executive insiders supplying the timeline remain legally untouchable. The architecture is complete. Engineered market volatility and tokenomic extraction function smoothly only because the federal agencies designed to police them have been structurally captured. Prosecuting these actions presents a profound legal paradox. Federal insider trading laws typically apply when someone breaches a fiduciary duty to obtain corporate secrets. But if a president unilaterally dictates a tariff pause and then issues a market signal based on that decision, they're trading on information created by their own executive authority. This philosophical loop is fortified by Supreme Court doctrine. If implementing tariffs and negotiating military stand-downs are classified as official acts, utilizing those acts to manipulate global markets is practically insulated from federal criminal prosecution. With federal agencies paralyzed, the pursuit of accountability has been forced down to state-level attorneys general, attempting to apply local consumer protection and anti-fraud laws. This synchronization of executive power and private digital ventures has converted federal policy into a tradable commodity, turning the highest office of government into an unaccountable for-profit enterprise.